Okay, welcome everybody to, I guess this is the first one, kind of the going over of the main management weekly market note for February 28th, 2025. Since we got the Friday is the month end, we'll do a little bit, slightly more data, I guess, on the returns for the month. The S&P finished February down 1.4, which is below the historical median and average returns. But if you kind of put some context around that, and look at the first year of the presidential cycle, we were actually better than history, which would have February down 1.7%. So nothing out of line, particularly there, even if it doesn't feel great. The sentiment indicators kind of soured on both inflation fears and growth fears, which were corroborated by some weaker than expected consumer spending numbers, some higher than expected inflation numbers. So we will go hit a couple of those things as we move through here. Here is the performance year to date. S&P is up 1.3 through February 28th. Europe's leading the way up a big 12.3, followed by developed markets at 8. On the year to date for the sector side, healthcare and financials are up the most, around 8%. While infotech and consumer discretion lag down 3 and 3.8 respectively. For the last week, fixed income was the best performer at 1.3. Emerging markets were the worst, down 3.7. And for the sectors for the prior week, financials were up the most at 2.8, and infotech down the most at 4%. Pretty big drawdown in infotech, led by the Mag 7. Anything you want to add on there?
I think Europe's the big standout that I see. It's been a very, very long time. I think the stat I saw was best performance relative to the S&P in 10 years.
Yeah. It's a 11-point gap there.
Which, maybe some reversion to the mean after such a long period of underperformance, but yeah. Certainly interesting, and continue to watch that.
So here's our recession dashboard. This is updated monthly. Kind of the point of showing the higher part of the table is, for perspective, these are the months before which we went into a recession. And then at the bottom, you see Feb 2025 is the current. We also have December 2019, just given the kind of pre-pandemic levels there, just to show how quickly things changed then. But the point being is February 2025, you can see, relative to the upper levels or the upper rows, there is one red item, and red is forward looking. So it's kind of, if things are going well, do we think, or muddling along as they are, do we think that given column is likely to deteriorate or improve relative to current levels? And given the kind of strength in the employment market ongoing, we think it's more likely to weaken than it is to accelerate. So that's why that's red, is looking forward. It doesn't say necessarily we're bearish on it. We're just saying, given the kind of what we've seen, it is probably going to be weaker relative to the past than stronger. And again, that's the only red on there. Point being, we don't think we're jumping into a recession here. Again, it's monthly. Each of these columns has a composite of several different indicators under each of the columns. So inflation is CPI, PPI, PCE, multiple things that we're looking at. But basically, this goes to show we're economy's kind of middle of the road for the time being. And until we start to see more reds show up on there, we're not particularly concerned kind of a recession.
Yep, agreed.
Okay, jumping into the weekly stuff. The big release this week was the core PCE, that is personal consumption expenditures, which is the Fed's preferred inflation measure. It was up 0.3% month over month, which is in line with expectations. Year-over-year figure came down to 265 as a high. I think that 0.5% figure rolled off. Basically, if there is a little bit of seasonality to this in January, if you think about it, both CPI, PCE, when you are getting, at the end of the year, if you have, say, a subscription service or, something you use regularly, generally November, December, you get an email or a letter that says, hey, this has been your pricing. We're now raising it in January. So that kind of feeds in a little bit to the seasonality here. And so when you see this kind of higher than expected, I mean, in this case, it was in line, but CPI and the CPI prints were higher. And that's one of the reasons that we think kind of the seasonality kicks in, is people were a little maybe discounting what they thought. But in any case, this reading's in line. The Fed's stated goal is 2. I think secretly they're probably okay with anywhere from 2 to 3.
Yeah.
They just don't want to say we're okay with that because it would shift market expectations. But as you can see, that year-over-year figure ticking down in a solid manner is good for the continued disinflation story. Anything else there?
I think that's good.
Consumer spending. So this was a miss. This dropped 0.15% in January month over month, and it's the first negative monthly reading since March of 2023. If you combine this with the bad retail sales figure we had, which some people wrote off due to weather, but basically this is kind of fuel for the bears or the pessimists saying, hey, the consumer's weakening. We don't like where this is going. That's not good for the economy. For us, January is 1 month. We would like to see a couple more months of this before we kind of view it as a trend. And it's important to keep in mind the year-over-year figure is running at 5.6%, which is solidly above pre-pandemic levels. So even if the month-over-month figure is down, the year-over-year figures continue to be quite solid.
Yeah. I mean, let's be clear, like it's not good to see a negative spending reading, especially unexpectedly.
Yeah.
Certainly raises some flags, which I think the market reacted to. But also, to put things in perspective, it is 1 month, and the year over year, when combining the past 12 months, is relatively strong. So something to keep an eye on rather than, drop everything and run.
Yeah, jumping out of the boat right away after one bad reading.
Yep.
On the income side, again, this is also constructive, up 0.9% in both of them a month. The year-over-year fell because the prior January was another strong one. And again, these are subject to revision on these income sides. They're also subject to kind of seasonality adjustments, which are pushed through in January. So you can see the two outsized readings in January. Clearly something's going on there. But they're running at 4.6% for incomes, which is still above inflation. And we like to say, keep in mind, even if the disinflation story is maybe a little bit slower than people would like, incomes are running above inflation, which means that consumers have real purchasing power. They're not having their purchasing power kind of be negative or eroded by, inflation that's running above the income level.
One thing to keep an eye on in incomes, real income, aka income after inflation, is something that really, really helped the consumer get out of the rut in late 2022. The fact that real incomes were positive and strong in 2023, I think, in our view, really helped the economy stay strong. It helped the consumer continue to spend. And at the end of the day, the consumer is the backbone of the economy. So having those incomes be higher than expected is a very good sign. Obviously, spending being weaker is not, but I think you'd rather have income remain high so that consumers can continue to spend even if inflation is choppy.
Yeah, and I will point out a lot of the times you see in headlines, they make a big deal out of one or two items, and this of late has been eggs.
Yep.
And there's been far more headlines written on eggs than probably ever. And it's important to remember that, yes, that is kind of that's kind of a scapegoat or kind of something easy to point to as one item that's gone up a ton. But what people forget is a lot of other items are not doing that. And if you look on, particularly like big household appliances and stuff like that, your cell phone, TVs, computers, like, NVIDIA's $3,000 AI laptop, like $3,000 is the cost of a MacBook.
Yep.
Like it's wild what they're able to do with the technology. So just because, headlines will lead you to believe that like everything's going up, it's important to remember that a lot of other things are going down and on the price curve.
Yeah, there's something like 300 baskets in the CPI, and you always pick out one. It's going to be up a ton.
One's always going to be up a ton.
And there's going to be one that's down a ton. You kind of have to look at that, the core trend or that kind of underlying median trend.
Yeah, agreed. So on the personal savings side, as one of the corollaries to when people cut back on spending, it usually means they're saving. And you saw that here. This was a big jump in the savings rate. It was a 32% month over month increase. That savings rate is now running at 4.6, which is the highest since June of 2024. You can see it's kind of been in until this month, kind of a choppy downtrend for the last 2 years. And a big part of the kind of bearish, pessimistic view on the consumer spending was they're eating into their savings. The savings rate is already low, 5.5 relative to 4.9 pre-pandemic, or 8.4 relative to, February of 2019. The bears were saying they're going to run out of savings. They're going to run out of savings. And that hadn't proven to be the case. Again, this is 1 month of data. This is a big jump. We'll see if it continues or if it reverts. But it is certainly worth noting that
Yeah.
people were, for whatever reason, they kind of pulled their horns in a little bit and
Yeah.
are saving this month.
I will say on the savings rate, it's one of those funny measures that gets a lot of attention, but if you actually look at how it's calculated, it basically these government agencies add up all of the income of all people during the month, add up all of the spending during the month, and then subtract them. That's the only way to really calculate such a savings rate. Is just a flow of all income minus all spending. So it's a kind of a funnily measured thing to look at. It gets a lot of attention. If you actually look, I don't think it's actually that indicative of where the economy is going.
Yeah.
In theory, of course, consumers need to save in order to spend later. Like it is a thing that, in theory does need to happen, but to look at 1 month reading or to look at even a year's reading, it can move all over the place and not really mean.
And you saw, you look at pre-pandemic, up February 2019, it was up at 8.4. Those consumer spending numbers weren't very different from what we're getting now. So it is a big part of it is just kind of the way the math actually works.
It's a residual as part of some calculation. It's not an actual.
And it's as a percent of disposable income, so it is on a fluctuating base as well. So that base, both the numerator and the denominator can shift in this thing.
Yep.
So we also got Q4 2024 US GDP, the second estimate. It was revised up slightly to 2.35 from 2.25 in the preliminary reading. Consumer spending was revised down. If you go to 1 decimal point, it was unchanged at 4.2, but it's 4.7 to 4.21, so you're splitting hairs here. That's still the best reading since Q3 of 2021. Again, people can find a way to look badly at this, and the bears will say, well, that was Q4. We know that was happened. That was 3 months ago. We're in March now. We've had a weak January number. We want to see what February and March come out. And so do we. We want to see what February and March comes out at. But GDP is a big number to calculate. It takes a while. The whole point being, as you can see, the stair-stepping up the last 4 quarters, all of 2024, that consumer spending was accelerating, which is a good thing. Whether or not that continues, we'll see. But again, even if it is the past, you'd rather have it going up than down.
Yep.
Core PCE. So this is similar. You get this quarterly as well as monthly. We showed the monthly earlier. That's what the Fed likes to look at. This is the quarterly figure. It accelerated or was revised slightly up to 2.65 from 2.5. Again, if you want to point to the spending being in the past, this is also in the past. We know this. We've been through this data, October, November, December. We've experienced this. So while people say, oh, it was revised higher, it's like we've already gone through that. It's priced in. The market knows what's happening.
Yep.
So not, worth noting, but again, not a huge bearing as far as kind of the monthly stuff. Finally, we got durable goods orders, which were up 3.1 month over month, solidly above forecast for a 2% rise. Notably, non-defense aircrafts and parts were up 94%. This is a super volatile category within the durable goods. So we like to look at core capital goods, which is kind of a business spending proxy. And that was unchanged at 0, missing forecast for a 0.3, which isn't, that's goods ex transport. Sorry. Core capital goods up 0.8, which is the biggest since August of 23. So that's a solid rise. Ex transports, they were unchanged. But basically, on a year-over-year basis, it's good to see all of those accelerating. And you can kind of see that trend on the right there. Hopefully, we're seeing a bottom, and this is going to start running up higher. The blue line is clearly more volatile, but we'd like to see all 3 of those kind of start to lift, as they have a little bit now, but there's still, a bit of run room to go.
How much do you think of this month's reading in particular was caused kind of by leading tariffs, trying to get ahead of anything?
Oh, I think there's definitely skewed with that. And you saw this this also showed up in the regional Fed indices where prices paid and prices expected to be paid and materials inputs prices. A lot of the trade numbers also are going to be skewed with people trying to front run tariffs, even if they don't know what's actually coming or what comes is less than they feared or whatever. The kind of uncertainty around them has led people to try to lock in prices while they can, so that they're better able to plan for their business spending and that sort of thing.
Yeah.
So this is kind of the summary page. Again, core PC up 0.3. We got Q4 GDP revised slightly higher. Durable goods orders in above forecasts. And this week, or I guess this coming week, we've got the PMIs. That's manufacturing, service, and composites. Balance of trade, we could see some interesting stuff in there, given the kind of front running of tariffs potentially. And then the big number is the non-farm payrolls on Friday, which I think are calling for 153,000.
Yep.
That would be a slight improvement from last month's 143,000. but also last month is subject to revision. So we'll see, but that's kind of a, it's a middling number. I think the replacement rate is like 250,000 jobs.
Yeah, it's a bit lower than you'd hope, but it's not as bad as it could be. So
exactly. Yeah. But I think that basically sums it up for the weekly market note, and we appreciate everybody's time joining us for this.
Yeah, thank you.
Take care.